today's U.S. Thanksgiving webinar entitled Talking Turkey, Will the U.S. Economy Continue to Fly? In this webinar, we'll be exploring the potential impacts of Trump 2.0 on the U.S. and global markets and what it might mean for your financial outlook. I'm very pleased to be joined today by Steen Jakobsen, former CIO and chief economist at SaxoBank, and Azad Zangana, who's an independent macroeconomist and strategist, and former senior European economist and strategist at Schroders. Thank you both so much for joining me today.
Pleasure. Thank you.
Thank you.
All right. As we start this webinar and we think about what may be happening under Trump 2.0, let's take a look at where we stand now. The U.S. economy is still growing quite strongly. We saw numbers coming through yesterday, 2.83% growth in Q3. We've got strong levels of consumer demand. Labor market is still looking pretty good. The initial jobless claims are still below forecasts. So we're still looking at that strong labor market. We've had equities, the S&P up. The S&P is up 25% so far this year. So all is looking really rosy for the U.S. But the question is, will it continue now that we have a Trump 2.0 after his rather large sweep during the U.S. election on the 5th of November, which of course took in the Congress, the Senate, and the House. So I'm going to start off with you, Steen. Since you are famous for your outrageous predictions, did you actually predict or expect a Trump 2.0?
No, I mean, in particular, if you asked me 4 years ago after he was ousted from office, I would have betted all my debt that he was not going to come back, because I thought he was an experiment, that he sort of did what he could in a very chaotic presidency. So no, I kind of sort of pre the election wrote a couple of research pieces where I wrote that Harris is bad for America and Trump is bad for the world. So I probably should have predicted it, because of course the world is not going to the polls in the US, but the Americans are. So I think it was a resounding anti-Vogue, a resounding center-left, and it was a majority that was in its scale and scope, and what it means was massive.
What about you, Azad? Were you expecting the Trump 2.0?
Certainly not 4 years ago. I thought he was pretty much done with his time in the White House, but as the campaign got going for this election, I thought he had a very strong chance, given the complaints of the population, and also the sort of the shock factor with Trump had sort of passed. I think people understood what he was about, and there was much more of a focus on his policies, and his policies, I think, spoke more to middle America, working America, and I think that was an important part of the population that the Democrats really just failed to win over during the election. So by the end, yes, I did think he had a pretty strong chance of winning.
Yes, at the moment it does appear the Democrats will be licking their wounds for quite a while. But let's get on to the point of this Trump 2.0 and whether the U.S. economy will continue to be, forgive my Thanksgiving puns, as sweet as apple pie. As I said, it's looking really well for the U.S. economy. The Fed has pretty much managed to get to that soft landing, or potentially even a no landing scenario, in the sense that we do have this growth. Inflation has been coming down. Stock market roaring ahead. But what are the implications when we look at Trump's policies? Let's get into look at those a little bit. We know about his tariff policies. He has initially suggested that he would have a 10% across the board, 10 to 20% and 60% on China. And then he came out the other day, just when the market started to feel a little bit better, because we had seen a lot of dollar strengthening. The markets started to feel a little bit better about his potential, or appointment, or nominee, I should say, because they still have to be approved by the Senate, of assent to the Treasury. And then he kicked off again on his Truth Social, talking about, no, we're going to have tariffs against Mexico, tariffs against Canada, and further tariffs against China. So what do you both make of these tariffs and the implications of these tariffs on the US economy, on global trade, and on the dollar. Whoever would like to start first?
Shall I kick it off? I think
Kick it off, please.
I think the impact for the US will largely depend on the scale of the tariffs and how quickly that they're applied as well. If we start with a very low amounts on certain goods in the way that the new Treasury Secretary is sort of suggesting we would, then the impact will probably be a lot smaller than if we had the full power, the full announcement, the maximist policy that Trump seems to be threatening out there. Naturally, we will see some disruption to supply chains, and we will probably, over the long term, and I think actually this has been my view for some time, that over the long term, there will have to be a significant change and reconfiguration of supply chains to move away from the Chinese market, essentially. And so hence that's why, for example, the Indian market has been doing so well, because they're clearly seen as one of the winners from that reconfiguration. But a major introduction of those kind of tariffs could be very negative for the global economy. Not only will we have that disruption, you'd have the price increases, of course, coming through straight away. And I think it could potentially be quite recessionary all for most of the world if it was to come through in one big go. But I think calmer minds will sort of prevail overall. I do think that the introduction will be much slower, and the threat of higher tariffs will be used to try to improve the US's ability to export into markets like China, or, for example, to get what they want with regards to migrants with Mexico, rather than just the full hit. Because I think once you've gone all out with these tariffs, you really don't have any room left to negotiate. And I do believe that fundamentally, the Trump team would like to actually improve things for the US, not just simply go out and punish the rest of the world.
Steen, what are your thoughts on this? Do you think that this is just simply a negotiating tactic by Trump? I mean, everyone refers to him as being transactional. Or do you think that these will actually potentially come through, particularly given who he's nominated for the U.S. Trade Representative, Jameson Greer?
I think the problem overall for Trump is that his game is known. So in game theory, he's sort of playing what is called the random card. He's doing random policy initiatives, which is the best strategy if you want to play poker or any other game where you sort of have to bluff your way through. But I also think in game theory, if you know the other guy is playing a random game, you can actually, of course, adopt your strategy to mirror that. Which is basically, you play the odds of the strong hands, and you sort of try to deal with the tails in a more minimalistic way. So I don't really think Trump's strategy, or the art of the deal, as he loves to call it, is going to work long term. I mean, maybe over the last 48 hours, seems like he got Mexico to the negotiation table by threatening to combine immigration with drug policy. Which is probably one of the in citation mark easier deals for him to strike because of the interdependence between the two, both in immigration and on drugs. But I've been in probably 20 macro meetings, and one thing is astoundingly clear for me is that no one has any real concept of what this will lead to. I think the only conclusion I will add to the excellent run through by Azad is that we know for a fact it's not going to be disinflationary. I mean, we don't know how inflationary it will be. We just know it's not going to be disinflationary, whatever happens. And I think in that context, remember what, a lot of people is blaming 1930s crisis on the tariffs being introduced then. But to be honest, it was more about the fact that the whole negotiation was held prisoner by the Congress at the time, which had the permission to negotiate. So basically, you had a goldfish producer in Ohio who got into the law as well in the 1930s. Today, it is the White House that negotiates these deals because of what happened in the 1930s. We had the gold standard, and it, to be honest, the currency, at least the crisis in the 1930s, to me, may have had the tariffs being the starting point, but the real issue was the gold standard and the currency devaluation needed in that process. And I think probably, fast forward to today, I think the currency impact is probably going to be big. I wouldn't be one to be long Mexico if they combine drugs and immigration. I wouldn't, necessarily be long Chinese renminbi, because clearly, sort of the repercussion from China could be a one-off devaluation of 30%. I don't think in practice that will happen. But we're dealing with a distribution that is very wide, with a very, very negative left tail and probably no positive right tail.
Okay, so looking essentially, I think everyone tends to agree that yes, whatever happens, you're going to have a higher level of inflation, but we're also looking at dollar appreciation. The consequent impact, of course, is, and that's a result of, if we have the higher inflation, we're going to be needing higher yields, gives less room for the Fed to move. This also impacts, of course, other economies globally. So looking at the UK, which is kind of in a stuck in between mode of it's having its own growth problems. It's just had a budget that has not been perceived particularly well by the markets. We have Europe, which is slowing down, and we are expecting a higher rate of rate cuts in Europe through to 2025. I believe the estimates are about 175 basis points coming through, and only 150, sorry, and 75 basis points potentially coming through in the US for next year. So where do we see Trump 2.0 affecting currencies globally, and what will we be seeing potentially for a response from central banks? Steen, do you have any thoughts on that?
No, clearly, I mean, even though Powell won't admit it, he's already with the FOMC sort of backing down from a more aggressive path forward for US interest rates. I think in isolation, is in the short term, it's only going to accelerate the need for European cards, similar to the UK. That is the conclusion of the market right now. I think there is a huge amount of seasonality in fixed income for the balance of the year, which is probably pushing against that sort of theme. But net, I think the concept here is that you don't. Again, I mean, I know the easy sort of conclusion is to say the dollar goes stronger, but it is also the same administration which publicly is decrying the fact that they want a weaker dollar, or put in their words, they want the rest of the world to have stronger currencies so they can have weaker currency, which okay, is the same difference, but kind of a different way to observe it. There's even been talk about Besson introducing like 100-year centenary bond associated with trade. So imagine the UK had a trade deficit surplus of 5% with the US. Then, tit for tat, they should be buying 5% of that GDP in bonds that should be, put into the treasury in the UK for 100 years and sitting there as a sort of a tax on money. Not doable, not practical, but there are a lot of ideas. But at the end of the day, as we all know, event risk is higher than the actual sort of follow through on it. And for me, net of all this means that, again, going to a sort of a normal distribution, I think it's not going to get as bad as people think, but I don't think it's certainly not going to get as good as the people who are, riding this sort of deregulation, growth policy positive. You probably all heard Besson is out with his 3 arrows, similar to Premier Abe did. He wants a 3% deficit, a 3% 3 million barrels increase in oil, and a 3% inflation. So, I don't think politicians dictates what the economy do, and I think for the European part, we are far more concerned about the French election over the course of the next quarter. Marine Le Pen potentially losing her political ability by March next year. We have election in Germany. We have a Germany which is without a growth in 8 quarters. I think the world has other things to do than think about Trump. But of course, Trump is the left tail of most political outcome and also economic outcomes.
Mm-hmm. Azad, what are your thoughts in terms of that currency impact and the ability of central banks, or what central banks and governments, in terms of their corresponding fiscal policies, may be looking to do, and how will that affect that overall growth picture?
Yeah, well, I mean, all the central banks are going to have to respond and react to the future changes in policies. I mean, you've seen Christine Lagarde overnight having to to give advice essentially on how to deal with the threat of tariffs and so on. I was at a speech that my former colleague Claire Lombardelli gave. She's now the new deputy governor of the Bank of England, and again, she was asked several times about the potential impact of tariffs. And while central banks can't respond to policy that are not there in place at this point in time, they more and more they are starting to use scenario analysis and scenarios as a way of communicating potential upside risks for inflation, downside risks for growth, as they see it with regards to the potential tariffs that are coming in. Now, when we talk about the difference in the outlook for interest rates, obviously this is one of the things that's driving the directional changes in the currency space, and it does mean that the changes to interest rates from the ECB, from the Bank of England, and other similar banks will have a larger impact on those currencies than they would do otherwise, when, of course, we have more synchronized central banks. Now, that's not to say that the Federal Reserve is not in cutting mode. I mean, they clearly are. They are looking to ease going forward. It's just a question of how much can they ease, how quickly can they ease. And, according to the markets today, they're not going to ease as quickly as in Europe. And I think that's perfectly correct, given how sweet the apple pie is, as we mentioned, Renee. The US economy is performing very well. The labor market is still doing reasonably well. Whereas Europe, it's starting to struggle. It's struggling with the lack of demand from around the rest of the world, the loss in competitiveness as well that they've had because of the energy crisis that we've had in recent years. So I think the disparity in currency is warranted, and I don't think there's any issue around that.
If that leads me, that thought of the struggle that Europe's having in energy in particular, is also brings to that point in terms of sectoral performance. Now, which sectors, based upon what we're seeing or is being suggested under Trump 2.0, do you see performing well? I mean, will we still see AI running to the forefront as we have this year? Essentially, what sectors are going to be turning into pumpkins, and which ones are going to continue to serve up the gravy that you see happening? Will we still see this massive level of growth in equity markets next year? We have the big investment banks are pretty much predicting another great year ahead. Are they being realistic about this? Are we looking, or should we be worried about valuations? Should we be worried about overly ambitious earnings expectations?
I think we've got potentially 2 stages to next year that we need to think about. And the reason being is we have the debt ceiling negotiation coming up fairly soon. From around the end of this year, the Treasury will stop issuing new government debt and will have to start funding itself out of Treasury reserves. So we know there's about $700 billion worth of reserves that are on hand ready to use. And I expect by the end of February or so, we will be somewhere between 250 to $300 billion worth of spend coming in. That is highly stimulative. That's a lot of liquidity going into financial markets at a usually quite an illiquid time of the year. So I think certainly the first quarter, maybe even up to the first half, I'm expecting a very strong start to the next year for equity markets in general, for treasuries as well. I expect a rally in yields, and the dollar may also weaken just on the back of that. But then as we get into the second half of next year, this is where the challenge will start to come about. Some of that liquidity will be reversed, and then we need to think a bit more about, well, which sectors are actually going to deliver on that outperformance. And when you look across the sectors right now, there are some incredibly expensive sectors, and we all know the story around technology. Although what I would say with technology is, AI and these kind of forms of automation are going to be incredibly important in coping with an aging population and a lack of availability of workers, which frankly the new administration is only going to make worse given their stance on migration. But clearly, the attitude towards financials and banks, they're going to be winners through deregulation. I think consumers could still do pretty well. I think materials will probably still do well. And where the areas I think I'd be more concerned about is healthcare, given the announcement of of who's going to be running those departments. I think there's potentially quite a lot of shake-up coming in on the healthcare side, and then those stocks are quite overvalued as well.
Okay. Steen, do you have any thoughts on which sectors are more likely to be affected, both either positively or negatively?
Yes, I'm not as eloquent and as politically correct as Azad here, but I sort of operated with a model I call the 10-90 model. If you look at the S&P 500, 90% of all assets are intangibles and 10% are tangibles. The speed limit to the 90%, which is what Azad talks about, the AI, the productivity gains, the deregulation, is that the real economy, the 10% cannot follow suit. How do I know that? Because you see, of course, Microsoft, Amazon, and all these are now tapping into energy directly at nuclear power to a large extent. We see a concentration of data centers in Virginia and in Texas. And basically, a publication like Gartner is now saying that in 2027, 40% of all data center will not have enough electricity to run the processes. So I think we are at an inflection point for the world where most generation that is in the market today thinks that you can just switch a button on the electricity switch, and there is a constant electricity, unless, of course, you're in South Africa. But for the rest of the world, that is not going to be the case. We will have to limit the amount of electricity use. Every time NVIDIA comes out with a proclamation of that they have done a faster chip, you have to remember there's a direct correlation between the use of energy and the speed of the semiconductor. We are seeing growth rates in the AI, the crypto world, which is really taking over basic needs of running an economy. So in other words, the 10% is now way too small for the 90%. And that, of course, is also my sector choice. So what I'm doing right now, and I'm an investor, so I'm more of an allocator than a speculator. But what I'm doing right now is that every time my benchmark on U.S. equity is reached, so in other words, let's for argument's sake, it's 25. If it goes to 30, I take those 5% and I reapply them in European infrastructure, in electrification, in energy provision, contributors, and the like. So I'm really shifting in sort of simple terms from paying 30 plus PE to paying 15 into a European theater that, of course, is perceived to me to be too negative, because ultimately we know when there is a crisis in Europe, they will step up. There may be a pro-European defense bond being issued, whatever. But I do think, I'm not going to buy the US stock market at 30 PE and then pretend that I don't see this as being dangerous. So I'm sort of more of a macro allocator, and for me, the valuation is in what the world is short of, which is energy, defense spending, cybersecurity, and certainly electrification and electricity generation in the actual grid. So I think there's a huge amount of upside in these sectors. I do not see value in other sectors, but I totally agree that pharma is a huge risk. I, of course, live out of Denmark, Novo being one of the prime drivers of the Danish stock market and the European as well. And they're doing miserably into this new sort of regime of Trump. But as you can tell, my theme would have been relevant with Harris as a president or Trump as a president. I just think it becomes more concentrated and things will happen faster, because the way I perceive Trump is he is the disruptor doing disruption, or in other words, he's a human wrecking ball. He doesn't build anything. He only breaks things down. We are not going to leave after 4 years having something that has been rebuilt. We will have everything being shattered. We'll have everything in pieces. But to be honest, having done this for 40 years, I think that's what the world needs sometime. And I think there are certain areas where it's absolutely needed to come in. And I think, UK is a great example. I mean, the political system in UK is failing day by day. You have a chancellor that is trying to do the best and getting criticized for doing what everybody's supposed to be doing. So it's kind of interesting. But you're not getting elected to do something new, which means that you need an external factor to drive the political landscape. That external factor will be Trump for Europe and Asia. And they can use him to sort of build up on defense spending, cybersecurity, energy, and not least tell a story that we will be coming back.
Very Schumpeterian approach of creative destruction. Okay, given that what you've just said about energy in particular and thinking about that sector, because Trump does have an energy policy that he's putting forward, and which, of course, is going to potentially change a lot of what's happening in the US in terms of the development of further development of oil, of liquefied natural gas, et cetera. And we're looking at a Europe that has been trying to move away from these and further into renewables. So when we think about sector growth and this auxiliary sectors to the energy sector itself, you're basically saying that yes, keep going within these sectors, or do you think what Trump is suggesting is going to affect that in any way, positively or negatively?
There's two things to say about that. One is that a barrel of oil is not a barrel of oil anymore because the refinery capacity globally is not there. So you can easily imagine a situation where you have WTI trading at $30, but the distillate of it, so jet fuel, gasoline, whatever, trades at 3 times the price today, because the capacity issue in terms of refinery is not there. So there needs to be a huge amount of refinery. They're super expensive, and why would you do refinery when you know you're not going to do raw oil anyway? You're going to natural gas across the board. They're gonna pump 3 million barrels more a day. That's the ambition from both Besson and Trump, which will put a downward pressure on it. But the fact is that the problem is not getting oil out of the ground. The problem is to deliver the electricity exactly where you need it, close to the data center, close to the spiking demand that is in the world. So the net result of all this being that if I look at the return profile of the US company I own in the same sector as the one I'm buying in Europe, they're up 35, 45, 55% year to date, based on this concept that everybody knows they need data center. They all know they need AI capacity. We see the CAPEX. Sequoia did a very famous paper by now where they sort of put out $600 billion worth of CAPEX from the major companies in the world, and commercialized value of that 125. That's a huge deficit that needs to be commercialized. And to be honest, and I'm saying this with a smile, but if Microsoft Copilot is the new version of AI, there is no way in hell you can justify the price on that, because that is the worst product I ever seen. I mean, I have Python programs that does better than Copilot.
Okay. Wow, that's a strong point. In terms of looking at the wider commodity markets moving forward, because obviously if we have these tariffs in place, we know they're going to be affecting supply chains potentially directly and indirectly. And obviously that comes through on the commodity side as well. Azad or Steen, do either of you have any thoughts on that?
I mean, when you get this kind of level of disruption, essentially what you end up with is parts in the wrong place in the world, the production being placed in the wrong parts in the world, and demand takes a hit until those supply chains can be reconfigured and shifted to areas where they still make economic sense. And during that period, you will see a drop off in demand for some commodities, for especially capital goods investment. And the leaders in capital goods production and supply have seen that hit. This is one of the reasons why Germany has been struggling now for a few years or so. But eventually you should start seeing a recovery, because at the end of the day, US consumers will still consume, along with European consumers, of course. So that demand is there. It's just a question of, can it be delivered in an acceptable way to the politicians, to the public of these countries. By the way, it's not just the US that's kind of disrupting and causing this reorganization of global manufacturing. It's Europe as well. I mean, Europeans have been very vocal about the cost of carbon and decarbonization, and the way that local producers are having to pay higher taxes in order to try to decarbonize. And what's happened is a lot of that manufacturing has shifted overseas to parts of the world where there are no taxes and there are no tariffs. And so they are looking to bring in a form of regulation and tariffs that basically say, well, look, we don't really care where your steel is produced. If it's not taxed accordingly, then we're going to tax it as you import it. And so that's also leading to a change in where that those supplies are coming from. And so I think as investors, we really need to think about where the risks are coming from for these supply chains. And like I said, who are going to be the winners and who are going to be the losers.
So keeping that in mind and thinking about what we've already discussed in terms of currency effects, potentially for next year in terms of dollar strength, then down the line, dollar weakening. We already see euro weakening happening, going towards potential parity on that. This brings in, we touched upon this a little bit, and we're talking supply chain. So I'm going to bring in kind of the boogeyman in the room, which is China, which is, of course, the second largest economy in the world. We've had the threat of tariffs quite strongly, and Trump's been very, very strong throughout his campaign and in his previous administration about China, bringing China down a little bit. We've mentioned, I think Steen, you mentioned degree of depreciation of the renminbi, but what would that actually mean? So where does China and the companies that are owned by China or Chinese owners fit into the supply chain issue, fit into this sector performance issue?
I think it's as Azad rightly says, the supply chain is the issue, and I think maybe one comment I'll make is that in the 40 years I've been in the market, we've been in demand-driven markets, and I think the big change that is happening with this destruction or disruption is that we are moving to supply constraints. I'm extremely bullish on commodity, not because of the demand, but because of the lack of supply and the lack of investment. Similarly for China, I mean, the whole illusion that we can operate without China is a joke. The whole semiconductor industry, rare earth capacity, they have 90% of all rare earth capacity production. And why do they have that? Because it's extremely toxic, and some of the byproducts of that is actually uranium, which is something the US and certainly Europe, as per Azad, deselected to be part of, which means that today you want to have more AI, you want to be the leader in AI. Oh, okay. But if you want to do that, you have to have semiconductor, which for the record is built in Taiwan or in South Korea mainly. And it's produced with germanium and rare earth metals that is not only harvested to a large extent in China, but also for end user purposes, of 90% is done. Solar cells, solar panels, it's I think 95% Chinese. Batteries, 90%. I can go on the list. So Azad is right to point out that the issue for the world is not the tariffs. It is if you restrict the supply from a country like China, you need to substitute that. And the substitution of, for instance, starting a rare earth mine is you have plenty of rare earth just north of me in Sweden, but there's no way in hell that the center-left governments in Europe will allow that to be reopened. So I don't know how politicians and business people and the market crowd will actually enable their thinking in terms of controlling China. You can put tariffs on it, sure, but they can devalue, and then we are back at square one. Again, back to my game theory. But this naive thought that we can decouple from China is wrong. Can we control them better in multilateral negotiations like the WTO or wherever? Yes, we could theoretically, if the US was interested in engaging, but they are not interested in engaging in the WTO and other places. And if you ask American sociologists and historians, they think probably the single biggest change to American society happened when the US allowed China to come into the WTO in 2001. And since then, it's been an irreversible one-way road where China is better at producing because the environmental cost is small and because the state capacity to, and this is important to understand, it's not like the Chinese government supports all companies in China doing rare earth. What they tend to do is they allow 30 companies to compete. And when they are both, in terms of an economic model, are working, then they don't, and then they take away all the support. Then these 30 companies need to fight. And out of that fight, 28 dies and 2 stands on their feet. And those 2 that stands on their feet are then the most productive and the cheapest producer of what they do in the world. They've done this again and again and again. But it's a fact that is not noticed by Western economists, Western strategists, because they just want to see what they want to see, which is China is a bad actor. It is a bad actor in many ways, but the fact of the matter is you're creating dependency that remains with the conclusion that Azad did just now. Supply is what's going to constrain the world for the next 4 years, probably for the next 10 years. And the way you sort of react to that is increase productivity. And for the record, that is not doing AI. That is real people, real economy, making better grids, better computer powers, your own semiconductors and the likes.
Yeah, and I agree with a lot of what Steve's just said, and it's worth sort of really pushing the point that, you know, one of the big problems that the US has with China is not so much the anti-competitive behavior within certain markets in terms of their supply, because of course that a lot of countries do the same thing, including the US, for that matter. But it's the way that it has closed off its domestic market from imports around the world. Now, that was acceptable when they joined the World Trade Organization, and they needed to protect their domestic economy. But enough time has now passed that they do need to open up. They need to lift all the tariffs that they place on overseas imports. They still have, 100% tariffs on what they class as luxury goods, and multiples of that if it's, for example, a vehicle or something else. The very wealthy in China will still buy these goods, but in reality, what they do is they go to Hong Kong or they go to Paris. They still shop, they still buy these things, but they just don't do it in China. So that is an area that can be slowly chipped away at. So I'm not saying. So what I'm saying is, there is hope that negotiations and pressure can lead to a change in the sort of the regime there. But I just don't think we're there yet. And I think what the other problem is that China's slowly kind of pulling away from working with the West. They're thinking about developing their own trade zones within Asia, their own kind of currency hubs as well. Which
We have that with the BRICS summit
exactly.
as well in terms of de-dollarization.
Exactly, and I don't, personally, I think having the whole world dependent on the dollar is pretty structurally a bad thing. But still, what we don't want to see is a full divergence in thinking, in policy, in the relationships that could break down. I don't think that really helps anybody.
And that brings me to this point of the wider geopolitical impact of Trump 2.0. Well, we've discussed the potential impact on the U.S. economy, potential impact on the European economies, but really when we think about it, what are the geopolitical impacts and how will that then either solidify or either in a good or a bad way some of the effects that we've discussed? What are your views on that in terms of his unwillingness about the points about alliances, whether they're in Asia or in Europe? Again, this point about what he's willing to accept in terms of leadership styles, I suppose, and requirements.
I think the military, NATO is the big one, and Ukraine, of course, sits as a number one in terms of the global impact. If you want to look for sort of waves based on a decision mode, seems like Trump's idea is that Russia keeps the 20%. They have that next through the invasion with a peacekeeping force coming in. Is there a peace dividend? Probably not. There will be a build-up on both sides of that demilitarized zone. I think I would not be surprised to see the European budget of defense spending goes all the way from less than 2% to 4% because it's needed as a deterrent at a bare minimum, not because I'm a warmonger. I think that's the first one. I also think that's where Trump is looking for early political victories. All of the immigration, whatever, is fine stories. But if he can start the presidency in February or March, standing in Camp David with Putin and Zelensky and getting a peace, he's going to buy himself a lot of time both with the voters and with the political establishment. So I think that is a key focus. For me, I'll leave Azad to talk about the rest. That's the only thing I really understand from this, because the way he has selected his cabinet, it looks like a coalition government in Denmark or in France. I don't think there's a clear sign. Early on, it was very MAGA, but Scott Bessent is the middle of the road guy. And now all of a sudden, this tit for tat policies looks like a social democratic coalition government in Denmark more than it looks as a MAGA policy. Doesn't mean it's going to end there, but right now, I think there's a huge amount of confusion in political circuits in Europe and Asia.
Zab, what do you think the geopolitical leftovers are going to be, as it were, given that not just with Ukraine, which is a very valid point, Steen has raised, but also in terms of the wider relationships and alliances, whether it be we still have the unresolved issues with, between the US, Taiwan, and China, for example, and there are rising geopolitical risks. The situation in the Middle East, particularly Iran, it still remains unresolved.
Yeah, absolutely. I think that there's a tremendous amount of risk out there, and the kind of the long running stance of the US slowly pulling away from the rest of the world is only intensifying those risks more generally. I mean, I think my big concern really is what might happen in Europe long term. Totally agree with Steen that over the very long term, Europe is going to have to find a way to make a greater contribution to global security through higher defense spending by having a bigger presence. My big concern really is the sorry state of European politics, in that we don't have an effective government in Germany anymore. And in the past, it would have been a combination of the French and the British that would have led the effort on the defense side in particular. With the UK now out of Europe, they don't really have a great deal of influence, and unlikely actually to really be able to do very much going forward. And of course, the political situation in France is absolutely terrible now. So my big fear is Trump goes out in a very bombastic way and demands greater spending and demands a greater input and threatens to pull out of NATO in a way at a time when, frankly, even if Europe wanted to do more, it just can't. It just can't, because it doesn't have the strong enough governments to step in and put that money forward. We all know that defense spending does not win elections. And we now have elections coming up in the two biggest states. And defense spending is not going to be on the agenda, at least not in a meaningful way. There'll be commitments, but nothing significant there. So I'm hoping that the US can take a more measured approach with Europe, at least until some governments are in place that can actually do a little bit more with defense spending. But the relationship with China, I think, will only go from bad to worse. Maybe a trade deal can be struck. I think Taiwan is a bit of a red line for the US. I don't think that they're going to allow any major change to the status quo, frankly. But at the same time, they're not going to publicly offer much in terms of support at the same time. And then the Middle East, well, I mean, there's a bit of hope at the moment in terms of the ceasefire that's in place with Lebanon, but I don't really see that situation being resolved anytime soon. And I'm not really convinced anyone really has an idea about how Trump is going to play that situation. Obviously, he's made efforts in the past to resolve the Israel-Palestine situation, but obviously it didn't lead to anything. Iran is one that he could be quite harsh on. There are rumors that there may have been or may not, there may have been some involvement in one of the assassination attempts, for example, in his life. And the anti-Iranian lobby in the US is very powerful, and they've been making some big calls that the US should get involved with Israel to intervene in Iran. So I absolutely don't rule that out, and it's potentially one of the upside risks to energy prices going forward. But again, going back to what I said right at the start, is that the US clearly doesn't want to be involved in any more wars around the world. It's too expensive. It doesn't really help them. And if they do it, then it basically sends a signal out to Europe and other parts of the world that they don't need to do it. So, I don't see a great deal of intervention there. Unfortunately, we're probably going to see more risks, more conflicts around the world with the US not really getting too involved anymore.
And that's when we're also, as going back to the very beginning of the conversation, where we are looking at economies that will potentially have slower growth if we have that tariff regime in place to some degree, and which eventually slows down, inflation goes up, brings down growth globally, and also, and of course, within Europe, as well as the US. Particularly in Europe, we do have specific demographic challenges and high social safety nets. So that does again, put pressure on European governments quite substantially, and therefore may make them less inclined, as you've pointed out, to be able to spend on defense or anything in related sector. Okay, great. So we've covered where we think currencies will be going, what asset classes will be the best stuffing for portfolios potentially. I want to ask one last thing, though. One asset class we can talk about are the alternatives. So what are your views, for example, on gold? We've had gold going way, way up this year. It's been down a little bit over the past couple of weeks, but it's still hit, it's well up over 20%, almost 25%, I think, this year. Where are your views on that, given what we're thinking about currencies?
I think the gold is, the net buyer this year, despite higher real rates and a stronger dollar, has been the so-called global south, or the old BRICS countries that are trying to get away from the dollar standard. They've seen what happened to the Russians and the inability to use the SWIFT system. They want to build an alternative. You see, like specifically in gold trading, Hong Kong is now stepping up, wants to be a global center. You see the oil contract and the gold contract trading in Shanghai. There are clearly initiative among these BRICS countries to separate themselves from the US. Because remember, although we love to talk about Trump on this Thanksgiving Day, and congratulations to all Americans, but by the way, the fact is he's gone in 4 years. So we need, when we talk about these things, we're talking about things that go way beyond that, decades upon decades, and all the way back to the old Bretton Woods system. Besson is on the record saying he wants a new Bretton Woods or a Mar-a-Lago accord, but it's going to be very difficult, because I think the rest of the world have decided that the Western democracies is not doable and not worth negotiating with. And if you look at the demographics of our world versus their world, if you look at their resources versus ours, if you look at the deficit to GDP, their numbers relative to ours, it's pretty clear that we have a need to have, as Azad just said, a eureka moment where we wake up and smell the coffee, because this sitting on the fence and doing bartering with both sides is not going to work for the future.
Azad, your view on that?
I mean, I'll go back to the original question on gold, because I think it's an interesting take. I think for me, gold was one of those geopolitical inflation trades that people were putting on just before the election, and it was seen as a bit of a hedge. And I think I still believe that it's the correct hedge to have in a stagflationary environment. In an uncertain geopolitical environment, gold is a good asset class to have in portfolios. The problem is that at the same time as we learnt of the result of the election, the steepening in yield curves and the rise in yields more generally, especially real yields, worked against the gold trade, and it therefore underperformed expectations immediately following the election. As you said, Renée, there has been a little bit of a bounce, so I think people are starting to add back in on gold, and I think that's the right thing to do for the next year or so, is to have some allocation there. But as I mentioned earlier, I do believe that with the debt ceiling negotiations coming up, there will be a lot of liquidity pumped into markets by the US Treasury, and that typically does help these kind of asset classes that don't necessarily have a yield or a dividend to pay. Typically, this kind of liquidity will boost commodities, gold, even cryptocurrencies as well.
Speaking of crypto, do either of you have, particularly Steen, I know you kind of covered this, any thoughts on crypto? We've seen Bitcoin coming at almost 100,000. It's dropped down, and then it's back up on the Trump trade, and the idea that the US will be the crypto capital of the world. And this kind of feeds into your point about the energy supply as well, because obviously that is required in terms of mining.
I've had Bitcoin in my portfolio at a very, very low percentage point for a very long time, and the point is, and I say that with a smile, but I made a rule when I was trading at Saxo, that no one over the age of 25 should be talking about Bitcoin. So as you can probably tell, I'm slightly above 25, but I give it a stab anyway. You have to remember that the biggest inequality we have in the world is between my generation and the young generation, the inability to buy your first home is the biggest limiter of future growth and wealth for young people. The only way they can get on this bandwagon today is taking a punt on the crypto world in their eyes and in their versions. You have a concept in the US called West Coast money, which is basically young people out on the West Coast taking their salaries in bitcoins instead of in dollars and the rest. So don't underestimate. A product's price is a direct function of how many people wants to trade it and own it. The supply of people who wants to do Bitcoin is increasing. The institutionalization of it through the ETFs and the likes, of course, broadens it out. But at the end of the day, we all have to remember that cryptocurrency sits on top of a blockchain. So the ultimate success of cryptocurrencies will that we sometime and very soon, hopefully, will start to adopt real blockchain in a grander scale that we do today, because that is the payment for the work done on a blockchain. But I'd see, in particularly among your clients here today, I think tokenization is a big talking point, and I think tokenization over the next 2 to 3 years in the asset management side will explode, because it is simply impractical to run a asset management company or a pension company today with all the cost of ratifying deals and regulation one way or the other. So I do see, say, for me, the upside on crypto lies in when we commercialize and start using blockchains. And I actually think we are much closer than we ever been to over the next 1 to 2 years. So if I was to make an outrageous call for the next 2 to 3 years, it would be that blockchain is widely adopted both in governments, but certainly inside trading, all the way to tokenizing pretty much every single asset class that we talked about today.
Wow, so that's a very broad statement in terms of that degree of tokenization. We'll see whether or not that pulls through, but we do know that we are looking at potentially more positive regulatory change attitudes out of the US, out of Asia, and potentially less so out of Europe under MiCA coming through. Okay, I think we've covered everything there. I just want to check if there are any questions that we may be having from the audience. I don't think we have any particular. Oh, we do have some, I think, if I may, coming through in terms of this issue of the BRICS initiative. We just touched on this a little bit in terms of that de-dollarization. Do either of you see this really progressing under the Trump administration and global reaction to his policies?
Clearly, Trump is closer to the South African leadership than the prior one, but I don't think they do this out of a need, and I think anything that is need driven has a longer and a better staying power, simply because they want to get away from the dollar funding. I also think deep down, some of the more longer term thinkers is arguing that the eminence of the dollar strength and the dollar's funding for the rest of the world needs to be challenged in order for them to ultimately end up with a bigger role and a bigger slice of the rest of the world. If basically, again, in same for if you want to be a superpower, you need to be getting away from the dollar standard. That's the way I would say it in sort of philosophical terms.
So do you think that we'll be looking more towards more de-dollarization under the Trump administration, or that everyone owns so many levels of U.S. treasuries? The U.S. is still the largest economy. Do you think that will not happen?
I mean, it's both a curse and a blessing. On the one hand, you have lower yields than you potentially would have otherwise, because of course all those holders of dollars are buying US treasuries, and that's how they're parking their money. But the opposite is the curse comes from the strong dollar. So other countries in the world have in the past tried to use fiscal policy to try to correct for that. So I think back to when Brazil had a tax on overseas investments in Brazilian government bonds or Brazilian rates, so that the interest rate that was on offer for international investors was therefore lowered, and that helped control some of the inward capital flows. But these kind of capital constraints, create other inefficiencies within markets, cause other problems. And maybe I wouldn't recommend them for a country like the US, but there are things that can be done. So it's up to the US. I mean, we said earlier that, you know, as part of the trading arrangement, that actually the US might demand more countries hold treasuries in their portfolios. That doesn't seem like a desire to step away from from dollarization at all. So I don't particularly see a dramatic change. I think China will exert its influence within the Asian region to try to boost its use of CNY. But I mean, frankly, at the end of the day, you ask, you know, most Chinese households, they are desperate to get their money out of CNY because of the historic, abuse of domestic wealth and what's happened there, and frankly, the quite likely devaluation that's coming fairly soon. So I don't, you know, it's not a free forming currency adoption as we have with the dollar. And you know, the Europe tried to do this with the introduction of the euro, and I remember speaking to Joe Stiglitz many years ago, thinking actually the euro could one day challenge the dollar to some degree, at least create a bit of an alternative to that. And it never really happened, of course. I think people quickly realized how vulnerable the euro is to the highly indebted southern nations and the fragilities that then presents. So for the time being, I think we are stuck in a dollar denominated world. With a lot of rigidities in various places.
Very good points. And particularly, we're looking at a potential euro crisis now, given the situation in France, as well as we're seeing that development in bond markets there.
Well, I mean, I think those calls are always a bit overstated. I mean, when the current Italian government came in, everybody was quite worried. All of a sudden, everybody was calm again. In the same way as when, Trump has just taken over, and everybody seems perfectly fine about it. There's, you may have certain views around migration, racism, and so on, but ultimately, what really matters for markets is the government going to be fiscally responsible? And as long as they are fiscally responsible, the markets generally turn a blind eye to most other things that they do.
Very good point. One question we have had come through is around the issue of debt and whether or not Trump will try to trade the debt using crypto. Steen, do you have any thoughts on that?
It's not doable.
Fair enough. We'll leave it at that. It's not doable. We'll leave it at that. Okay, I think we're coming to the end of our time. I don't see that we have any other questions coming through. So I would like to thank you both very much for your views of Trump on what Trump 2.0 will mean for the US economy, the particular sectors that investors should be considering and why, particularly that great points about the energy development, Steen. And what we'll be seeing in terms of currencies, dollar appreciation, euro depreciation, effect on other emerging market currencies, and of course on the Chinese renminbi. And of course those geopolitical leftovers that we have to think about and the levels of risk that we've all agreed will be rising through 2025. So I do have two questions who've just come through. So right before we end, my apologies, is this point of Germany being the main driver of the Eurozone, and how both of you see Germany evolving in the next 2 to 3 years, particularly in relation to that debt ceiling. We've had some discussion about the removal of that debt brake that has existed. How do you feel that will impact the long end of the curve of Eurozone bonds, particularly German bonds, but across the Eurozone overall?
If it was removed, then you would see steep yields across the whole curve, to the point where you may start, questioning whether German bonds are indeed the safest market in Europe going forward. But I just don't see that coming through. I think the next coalition is more likely to be fiscally conservative, or the SPD will lose in terms of their dominance in Parliament, and we will see a bit more consolidation going forward. The challenge for the German economy really comes down to the very large manufacturing and industrial base that they've obviously had for quite some time, losing its competitiveness because of rising energy costs, because of where the growth was coming from, which was China, and of course the problems that they are seeing, and also the aging populations that we're seeing as well. So labor costs going up. The rest of the economy is actually performing reasonably well, and so I think in time we're going to start seeing either Germany having to really starting to invest once again in its own domestic productivity, or slowly shifting away from those industrial sectors and thinking more about creative industries or finance, for example, or other areas that they can do well, because they really don't have enough labor, and they don't have the ability to import any more labor through migration, given the political situation, to be able to continue to compete in the low value added manufacturing that some of the areas that they have dominated for some time.
Oh, excellent points. Steen, did you want to add anything?
No, I mean, when you talk to German economists, German politicians, it's pretty clear that the Schuldenbremsen. I think Merkel once said to someone that in German, Schulden equals yes, a very negative feeling, emotion with Germans. Schulden is a little bit like having bad faith. So it's very difficult to turn the Germans around. I think the saving grace for Germany will be that Europe-wide needs a deal here. So it's probably, for me, more likely that you will have pan-European defense bonds or something of that nature. Of course, that will take longer to enact, but the election in February is very clearly going to be probably swaying towards Merz and the CDU. It will be a minority government, and that then needs to run for a little while. So we are, and that's the difficulty for Europe. We are at least 1-2 years before we get a resolution on this. But it's going to be interesting to see whether we get that right-wing swing that we've seen in every single election in both Europe and the world since 23, and where that leaves sort of the spectrum on the Schuldenbremsen. But the Schuldenbremsen right now is a factor that stops the ability of Germany to revitalize the economy for sure.
Great. Thank you both so much. Okay, well, I think we have run out of time. Thank you again, both of you, for joining me on this webinar on US Thanksgiving. We've had, I think, maybe not a stomach full, but we've definitely gotten a very good, it's helped build up actually even more of an appetite to find out what will be happening next. So with that, I'd like to thank the audience for joining today's webinar, and please do look out for future webinars on our global economic webinars. Thank you very much.
Thank you.